And next we have up, I love those Power 5 people. That was fabulous. I just love that QR code. I mean, it can make such a difference in people's lives. It's just unbelievable. But next we have my friend Mark Vernick. He's a certified financial planner, and he's going to chat with us about caring for your aging parents. I've known Mark for about 22 years. He was in the very first networking group that I joined when I moved to Florida. And I'll tell you, when I hit the big time, Mark is the first person I call because he's a man of integrity. He stands by his word, and I think he's got a lot of good stuff to tell you all today. So welcome, Mark.
Thanks, Linda. Great to be here. So let's see, I believe I can share my screen.
Yes, you can.
Which I will do. Bear with me. Here we go. I'm going to share that. And we'll start. So I told Linda I didn't have any slides, but I lied. I just decided that it was better for you not to have to stare at my face the whole time without a picture there. So I did create a few slides just to ease that pain a little bit. So what I'm talking about today is financial planning for the caregivers and those they plan for, right? So when I started my practice years ago, we have a tagline and we say generating wealth across the generations. And what that's meant to allude to is the fact that what happens with grandma and grandpa affects what happens with mom and dad, which affects what happens with the grandkids, all financially speaking, of course. So that multi-generational approach is important. And of course, a lot of you, and I understand not all of you, are caring for family members. So there's an element of that we want to make sure and talk about. So again, we're not just talking about the people that you're caring for, but yourselves. And I jump on the same bandwagon that I know Linda preaches on a daily basis, and that is you have to take care of yourself as the caregiver. It's not just about the one that you're caring for, because if you don't take care of yourself, both physically, mentally, and financially, then that blows up the whole works, and it really can ruin it for yourself, but also for the one that you're caring for as well. So let's start with, if my slides will advance here. There we go. Financial planning for those under your care. So again, we're going to start with those that you're caring for as opposed to yourself. And how do you do that, right? It's important when you become a caregiver. Obviously, there's all the physical things, right? Caring for the person, caring for their mental well-being, for their physical well-being. But what also happens, and where I tend to be brought in, is when it comes to their finances, right? Mom and dad, sister, cousin, husband, wife, whoever it is that you're now caring for may have been the one who was caring for all their finances as well. They handled the checkbook, they handled the investments. They were in charge of all the insurances and different things that make up one's financial life. And now, for a myriad of different reasons, perhaps they're unable to, or just don't really feel up to it. And by the way, that happens a lot. It's not that they can't, it's just they really just don't feel up to it anymore, and they need some help. And I understand that's where the caregiver comes in. So I want to talk about those elements and things, how we can help and how you can help them in taking care of their financial planning and their financial well-being. So the first thing that I find when we have, usually in most cases, when we're presented with a case like this, it's what I call the adult child. And the adult child is, usually in their 50s plus. More often it's the woman of the household than the man, who's now the caregiver. And now they find themselves again caring for a parent or a loved one or a spouse. But again, not only caring for the person, but having to take care of all the financial obligations as well as their own work, as well as perhaps their children, right? It's that classic sandwich generation that we've heard about, and I understand many of you are living. So the first process to me is to gather all the documents, to gather all the information. And I'm a big believer in the 𝐶ISS principle. I assume you know what that is, right? Keep it simple. They say keep it simple, stupid. I don't really like that word too much, but keep it simple, seriously, however we want to say that. But the idea is to simplify things. So what I found is a lot of especially our most senior generation, tends to be spread out, right? They've got 3 different CDs at different banks because they were out shopping for different CD rates. They've got different checking accounts at different places. Perhaps one had an introductory offer at one point, so they open an account over there. They've got their regular bank account. By the way, it's important to determine which one, for example, Social Security goes into or direct deposits go into. That's the one that we probably want to hold on to avoid a lot of other hassles. Financial statements and assets are something that we want to gather. So how do you do that? In today's world, one of the best things, of course, is still to check the mail, right? A lot of us still get our statements and information in the mail, and you really need to pay attention to that mail because that person you're caring for may just simply not remember something. And by the way, some things, for example, life insurance contracts or things like that, only send a once annual statement. So it may not be something that they receive weekly or monthly. But also, if possible, you want to have access to their email because, again, in today's world, a lot of us have gone paperless. Sometimes it's not by choice, right? If you've ever seen those things, you click on something and it says, if you don't uncheck this box, you're going to be paperless. It's a negative response. And so sometimes people have gone paperless and they don't even realize that they did so. So being able to watch emails for statements and things is important as well, because we want to gather that stuff. And the same goes for bills, right? And again, a lot of times those are now paperless. We want to make sure we're keeping up with bills so that they may have done automatically. But my strong suggestion to you is to simplify and to limit the number of accounts and places that you deal with. So oftentimes when a client comes to us, if they've got 4 different bank accounts, we're encouraging them to reduce it to 1. That primary one that you put and take and pay bills from is usually the one we want to keep, maybe a separate savings account. And the same for investment accounts. They may have an old 401k from a work that they're no longer working at. They may have some IRAs, or they may have a regular investment account. But to be able to consolidate those as much as possible, right? Certain things have to be kept separate for a myriad of different reasons, and I'll talk a little bit more about that in a minute. But as much as you can reduce things down for you as the caregiver and now the caretaker of all these financial instruments and responsibilities, the less accounts and the less places that you have to go and chase things down and coordinate, the simpler it's going to be. So that KISS principle is something that I can't encourage enough. And the same thing goes with bills and liabilities. And so in essence, if you know what a financial statement is, right, we've got assets on one side and we've got liabilities on the other side, right? We should be able to have that consolidated on one piece of paper, or there's all sorts of apps or software, things that you can do it. But even just as simple as a ledger, here are my assets, here are my liabilities. We kind of then know what a net worth is and where everything is. It's all in one place and it makes it simpler. Again, there's great software. We have a planning platform we use for that type of thing, but literally just a piece of paper can suffice if that's the easiest thing for you to do. The other is legal documents, and I'm going to spend a little bit of time talking about this. And full disclosure, and my little liability type thing is, I am not an attorney. I don't claim to be an attorney. I don't want to practice law, but I deal with these documents on a regular basis, and I find that there is a lot of misunderstandings, or the nomenclature and the names of them can be confusing. So I think sometimes coming from my perspective or using my words and non-attorney words hopefully helps clarify some of this and people understand it. But you want to have your hands on these documents, assuming that the person you're caring for has these documents. So, and in my opinion, some of them are even more important. We all know about a will, right? But a will, of course, happens when somebody passes. And certainly we hope that for the person you're caring for, that's a long time away and it's not something forthcoming tomorrow, but still an important document to have. But there are documents that you need to help in your ability to care for somebody that, at least in that role as caregiver, are even more important than a will. And the first one is power of attorney. So power of attorney is for those business transactions, right? You need to be able to do banking for somebody. You need to be able to sell their car. You need to be able to handle some sort of business type transaction for them. Then ideally, you would have a power of attorney. You may not be the person with the power of attorney. You may have been thrust into the caregiver position and somebody else may have power of attorney, which could be actually fine. Kind of a separation of church and state, if you will, but you need to know who that person is and be able to coordinate with them if that person is not yourself. Now, that power of attorney document is a very powerful document, especially in the state of Florida. It's not springing, it's a durable power of attorney in Florida. And so that person literally can become you. So I say that the person you're going to name as your power of attorney, I say you got to trust them on steroids, right? Because that person really, if they've got ill intent, can really do some damage. But so you really want to find the right person for that document, but it's important. Again, it may just be that they can't handle these affairs anymore, or they just don't feel up to it. They don't want to go to the bank. They don't like to get online. They're not comfortable on the computer to pay bills. They don't need their car anymore, but boy, they don't want to have to go and deal with selling it. They'd rather somebody else handle that. The other is, and it has several different names. I've listed it as a healthcare directive. Sometimes people call it a healthcare power of attorney, healthcare surrogate. There's different names for the document, but that's the one that says, if I can't, or I'm unwilling to make health decisions for myself, this person named in this document can do so for me. Now it's different. It's not your living will. It's not a DNR. It's not your regular will. It's a healthcare directive. Sometimes it is part of the power of attorney, depending on how the attorney drafts it, but it's an important document. Again, it's not necessarily, the common scenario is I'm conked on the head and I'm in the hospital. I can't speak for myself, and they've got to get somebody to authorize surgery, as an example. And so that healthcare person named in that healthcare directive can make that decision. But again, what we find oftentimes is somebody just doesn't feel well. They're in the hospital. They just, the doctors are in, and if you remember the cartoon Peanuts, Charlie Brown, start sounding like Charlie Brown's teacher. Wah, wah, wah. They don't really know what the doctor's saying and what the nurse said. They're under the weather. They're under medication. So that healthcare surrogate, that person named in that healthcare directive, can then have the authority to speak to the doctors and help with those decisions. The medical profession lives under all those HIPAA rules, and so they're very nervous about disclosing or talking about any of that information without that authorization that document provides. The other one that I've listed there is the living will, right? That's the whole thing that was derived from the 𝐄𝐍𝐉𝐎𝐾 case, if you remember that, here in Florida. And that is, no heroic measures, right? But that's an end of life document, right? When it's determined that the end is near, for lack of a better term, that's when that comes into play. And again, living will can be very customized. It's not black and white. I want measures to be taken to keep me alive, or I don't. A good living will, you can actually give some direction. You can say, I want all options tried on me first before you give up. If there's some new therapy that may become available, I'd like to try that first before you give up. It's a personal decision too. There are people who may wake up and say, if I can't take care of myself, if I can't function independently, if I can't do any of these things, and my health is really declining quickly, then I don't want to be long for this earth. Somebody else might say, any day I can wake up and see my grandchild, right? Any day I can wake up and see my spouse, my family, or watch a good program on TV, that's a good day. And so they can direct accordingly, right? It's not black and white. DNR is do not resuscitate. And and by the way, that's a doctor's order, right? That's something that's signed by your doctor. To me personally, that's something you do end of life, right? That is, I don't want the paddles to restart my heart, right? But I caution people on that one, because make sure you're at that point, right? For me, I'm a 59-year-old guy, and maybe I do something stupid and I stick a fork in the light socket and my heart stops, right? I don't want a DNR, right? I want that paramedic to come and shock my heart and press on my chest and get my heart going. But we also understand that there's a point in time in life where you're so, you're ill and not long for this earth, and that type of resuscitation can be painful and damaging and could break ribs and all those horrible things that can happen. And so that's perhaps when you want a DNR. But I find that sometimes confused is the living will and the DNR, right? The living will is, don't hook me up to machines. I don't want feeding tubes, that type of thing. DNR is literally, if I'm dead on the table, if my heart stops, if that happens, no matter what the reason, right, I don't want to be resuscitated. So just a word of caution. I think it's important for some people, but again, for others, it may not be what they're really looking for. A will, of course, is that directive for the court at the end of your life. So a will doesn't avoid probate. There's that term probate that some people feel is an evil, scary word. I don't think it's quite as bad as some make it out to, but probate is a court process by which a court supervision of the distribution of your assets after one passes. So we hope that the person you're caring for has a will. It gives direction. The states will have their own will, if direction that things go if there is no will. So, but a will does not avoid probate. It's direction for the court during probate. And then there's a trust, which is a whole nother element. I don't want to get too deep into a trust, but it's its own entity, and you title things to the trust. If there's any one thing that I want you to know about a trust is, if you or the person you're caring for has a trust, if nothing is titled to the trust. So I have the Mark Vernick Living Trust, right? That's basically a name of a trust if I was having a trust. And if I have a bank account and my bank account just is titled to Mark Vernick, it's not in the trust, right? It's not part of the trust. The trust doesn't cover that asset. So that asset wouldn't avoid probate and all the benefits of having a trust would do. If I have a trust and I want that account to be part of the trust, we have to do what's called funding the trust. And all that means is you have to get the title changed on the account and that document filed with that account that shows that you have a trust. So then my account would be titled to the Mark Vernick Living Trust and the date of the trust, et cetera. So if you're looking at, as you're gathering all those documents and you're gathering those accounts and those statements, and you notice that there's some account that this person has a trust, first of all, and there are several accounts that aren't titled to that trust, it's something that you may want to consider. And again, if you're able, if you have the proper documents in place, if you have power of attorney and different things that would allow you to do so, or your person that you're caring for is still able to make those decisions, getting those things retitled will be beneficial to all. And then knowing who the contingent trustee is on that trust, who can handle those things for that trust, is important as well. The one thing that you want to try and avoid, if you can, is having to be named as guardian. We deal a lot in my office with guardians, family members who end up as guardian, professional guardians that are court appointed. The issue with guardianship is it's costly, right? It's a court supervised program by which there's somebody who cannot care for themselves for a myriad of different reasons, cannot handle their own affairs. You can be the guardian of the person and the guardian of their stuff, right? And usually you're both. But as a guardian, there's filing and there's court processes, and you need to be paired with an attorney, and there's legal fees. And where I see that come into play most is when that person didn't have a power of attorney and there wasn't anybody who could officially stand in without a legal document in place, because again, they hadn't named that a person to handle their affairs. So now you have to go to court, you have to get somebody named as that position. Now they're a guardian, and it's a whole nother layer and expense that you want to try and avoid, and another reason to have a power of attorney. But if you are, again, you have to deal with those things accordingly. The other thing is insurance coverages. And again, if that person is in your care, it's most likely they've got some health issues, some mental issues, some things that are going to need health insurance, and insurance coverages are going to be important. There's obviously the property and casualty type insurance coverages, which I didn't list there, that homeowners insurance or car insurance, which of course are still important, assuming they have those things. But specifically, you want to have a grasp on what type of health insurance they have. Are they on Medicare? Do they have a Medicare supplement? What does it cover? Do they have life insurance? Life insurance is a funny thing. Life insurance, if somebody passes and they had a life insurance policy and nobody knew they had it, there's no central repository, or the insurance company isn't going to come hunt down the beneficiaries to say, hey, you know what, this person had life insurance and we want to give you money. It'd be nice if they did, but that's not the reality of how it works. So you want to make sure you know where those policies are, and you want to know who the beneficiaries of that life insurance policy is, and make sure that makes sense. And a lot of times life insurance policies have options or have riders where you can use some of the benefit for that person who's covered by the life insurance policy during their lifetime. There are life insurance policies that say, if this person is permanently disabled, they may be able to forward or front out some of the coverage, some of the death benefit while they're alive for their care. Obviously, that would reduce the amount of death benefit when they pass, but it's not true of all life insurance policies. So you need to look at that policy or have somebody review it for you and see if that's an option. But it's something that I think people oftentimes miss, where there's a source of funds that may be able to help that person during their lifetime, as opposed to just the beneficiaries receiving a death benefit when they pass. Disability insurance, if somebody is employed, a lot of times, or if they're below 67 or 70 years old, they may have a disability policy. There's also government disability insurance that's a little different, that I'm not going to cover quite at this moment. But if they have that disability policy, especially that long-term disability policy, and they're under 70, that may give them income. Again, you got to know it's there. It could be an employee benefit. It could be something that they purchase separate. And then the final one is long-term care. I don't find a ton of people that have these policies, but they are out there. They're not inexpensive. The biggest mistake that I see with people who have long-term care coverage is they want to save it. They say, because usually there's a limited amount of benefit that you get with a long-term care insurance policy. It may be so much per day or per month for so many years worth of coverage. I could spend a whole hour just talking about long-term care coverage, but my strong suggestion is you don't wait. If you qualify, right? So in order to get the benefit from long-term care insurance, you have to qualify for that benefit. It usually has to do with what they call activities of daily living. It means that you have to not be able, or the person who's covered by the contract cannot do certain activities of daily living, feeding themselves, transferring, toileting, dressing, things like that. Or usually the other trigger is just cognitive disability, where they have dementia of some sort and just can't function mentally. But once somebody qualifies for it, my strong encouragement is that you apply, you enroll with the insurance carrier as soon as possible. One, because there's usually a waiting period until the benefit pays out. And that clock usually starts as soon as you apply and show that that person is meeting those standards that they need that care and they would qualify for the benefit. And a lot of times it's kind of like it's a waiting period. It's 90 days or 100 days that they have to qualify before the benefit starts to come out. So the sooner you apply for it, the sooner those benefits would come out. And then the other thing people say, but I have just this limited amount. I want to save it in case I need more of it later. And again, I strongly encourage them not to wait, because if you wait, heaven forbid, you had 3 years worth of coverage and you waited a year and then survived a year, you gave up a whole year's worth of coverage that you could have had. You can't go back and say, gosh, we qualified a year earlier. Can you go ahead and pay us now for those things that you would have paid for? It doesn't work that way. The worst thing that happens is you use it up and then you have to go to the other assets. But I would much rather see you use the insurance money first, the insurance company's money first, before using their own or your own money to do that. So use that long-term care if it's there. So you find yourself as a caregiver, and as a caregiver, and if you're a caregiver again of the person's finances as well as the person, you're now a financial planner for that person. I've got some letters after my name, CFP, Certified Financial Planner. That means I've studied it and I made a career out of it. But if you are a caregiver and you're taking care of all that person's finances, you're tasked with being their financial planner in a roundabout way. You can obviously reach out to other professionals, but that's what you're trying to do. So the first thing is to devise a plan. So what are the expenses? Where and how do you pay for them? And I find that if there's a common mistake made by people handling somebody else's finances, it's just gathering everything up and then determining the most tax efficient, usually is the issue, the best place to pay for things, assuming that they have assets, right? Assuming that they have assets, what's the best way to pay for this additional care or to pay for just their regular monthly expenses and things that they need? And I like to say it's a net sum game, right? It's not only what they make, but what they keep after taxes. So you're going to need to learn about some of the benefits. They have, if they're on Social Security, then that's already a done deal. If they're not, that determination of whether they should take it now or wait, or if there's Social Security disability that may be involved, any of that type of planning, especially when it comes to Social Security or Medicaid type planning and benefits, that my strong suggestion is you see an attorney that specializes in that. We work with those attorneys, but definitely not my place to delve into too deep, because I wouldn't want to mess it up. But knowing that if somebody is qualified for those benefits, it's very important as you handle their finances that you're working with that attorney or that person that's helped set you up for those benefits to make sure you don't do something that blows up that benefit. For example, a lot of times, especially I know in Florida, the home, your primary residence, is a protected asset, right? So sometimes people come to me and they say, I'm going to sell their house because we need the money to help pay for this, that, or the other thing. And I'm always like, well, wait a minute. Are they receiving Medicaid? Are they receiving some of these other benefits? Go talk to your attorney first before you start selling off their primary residence, because that's very likely a protected asset that could otherwise be kept and you wouldn't have to be spending it down. So make sure you're coordinating with those professionals, especially if somebody's receiving public benefits. When somebody reaches that magic age of, now it's currently 72, used to be 70 and a half, they have an IRA or a 401k, one of those retirement plans, they have to start taking those required minimum distributions. And if they've got to take it, those distributions are taxable. And so we want to make sure and do that, because if you don't take that required minimum distribution every year, and there's a formula for it beyond the scope of this discussion, but if they don't take those, there's a 50% penalty. So I'm making up numbers, but if they had to take a required minimum distribution of $1,000 and they didn't take it, they could have a $500 penalty for not taking it. So it's a really egregious penalty, and you want to make sure that they're taking those required minimum distributions. If they have rental properties, again, it's possible, you want to speak to the attorney, that those things, that the rental income, those rental homes sometimes can be a protected asset, right, from Medicaid and things like that. So you want to speak to the attorneys about that. Annuities, again, are one of those things that there's tax ramifications taking it from. And if they have investments that they've had for a long time, if they've got that stock that they bought 30 years ago that they paid next to nothing for, and now you're thinking of selling it, could be a taxable event. You want to be cognizant and wary of that. My point to it is, it's a net sum game. You want to be wary of taxes and take from the places that you need to, and that are most efficient for you to do so. But sometimes I see people make the mistake of just pulling a whole bunch of money, for example, out of an IRA or 401k, or selling a piece of real estate that might otherwise be protected. So just a word of caution there, that you want to take it from the proper place. Managing assets is somewhat what I'm already talking about. If you're a guardian, if you're court appointed, you're a fiduciary. If you're watching TV at all, if you watch any of the channels I do anyways, where they've got firms and companies that do things that I do, and they talk about the importance of the person you're working with or the firm you're working with being a fiduciary. And I'll talk about that just a little bit more in a moment, but it's important to understand that in your position, if you are or are not acting as a fiduciary, because it's a very high level, a very high standard of care. And it's a good thing to do, but it's also, in a way, it's a liability, right? You got to make sure that you're meeting those standards. Otherwise, you can be sued or have other problems if you don't. You want to make sure that you're working with that tax professional. There's a lot of the expenses that one has if they're ill or unable to care for themselves that are deductible. There's the possibility that if you're the primary caretaker and that person's living with you, that you may be able to deduct them on your tax return. So understanding those tax benefits, I struggle to call it a benefit because somebody's ill, but it is a benefit, at least from a tax perspective. It's important to understand those and work with that tax professional to know whether you can benefit from those tax deductions or the person you're caring for can benefit from those tax deductions. And again, that may help us understand where you need to pull assets from or how you're going to pay for things, assuming that they have those assets. And again, I said before, you want to consolidate, right, as much as you can. If you can consolidate, at least have that one primary bank account that income goes into, or if they've got dividends, or if they've got Social Security, or whatever those monies that a pension, that it goes into that one account is my strong suggestion. And then that same account is the one that the bills are paid for. You know, some of us call it your put and take account, right? It's where the money goes in and the money goes out, and those regular weekly, monthly, annual expenses come in and out. And when you can, again, to simplify your life as a caregiver, if you can automate those payments, again, you've got to make sure that the money's in the account, right? You don't want to automate payments if the account runs so tight that there are points in time where it couldn't pay the bill. But in general, assuming that there's enough money in the account, automating those payments, and I think you all know how to do that. I just find that sometimes people don't always think about it. They're so overwhelmed with all the other things and caring for the person. If they just go online and automate that electric bill to come out of the account every month and automate that car insurance bill to be paid every month, it really simplifies things for you. And it may be something that more senior person had never done because maybe they're not as comfortable on the computer or online and things as you are. So fiduciary, there used to be a standard, they call it the prudent man rule. Of course, that's not exactly correct. The prudent person rule would probably be more appropriate, but the prudent investor law said that you would do what a person marked by wisdom or judiciousness, shrewd in the management of practical affairs, right? What a prudent person would do. And that was one level of care. Now, the higher level of care is a fiduciary standard. Fiduciary standard of relating to or involving confidence or trust, one that holds a fiduciary relationship, acts in a fiduciary capacity. So what does all that mumble jumble means? When somebody comes to me and they say, what does a fiduciary do? Or you ask somebody in my profession, frankly, I think that the general response that you'll get is you have to do what's in best interest of, we say, the client, you know, the person you're caring for, the person that you are handling their affairs. You have to do what's in their best interest. That's a fiduciary standard. But I think the more challenging part to that is, how do you do that, right? You have to, you know, I joke about it, maybe it's not funny, but when you're, especially, of course, I think of investments, that's the world that I live in. But if we're investing money for somebody, it's not that we can't invest in something that goes up or down in value. We can't really control the broader market, but we can do it in a thoughtful, logical, well-planned fashion. There's a plan for it, right? And it's documented. And I'm a big fan of documentation, even for friends and family. You know, I bet there's not one of you out there that doesn't have that one person in the family that might kind of question some of the financial things that you've done or the decisions that you made with mom or dads or husbands or aunts or uncles or friends' funds that you're now in charge with, and hindsight's 2020, right? Hindsight is always 2020, and they can always look back and said, you woulda, shoulda, coulda. But if you have a thoughtful, logical process, even if it's just a notepad that you write things down on and you say, here's what I did and here's why I did it, right? When we're working with guardians and people in charge of other people's money, we have regular meetings and we review what their budget is and how much money do they need a month and what's the best way to generate it. And are they long for this earth? That's we call that time horizon. All those things are things that a fiduciary would keep in mind in trying to manage assets. One would think, well, if I put it all in the bank, it's safe and secure, and that way I'm not taking any risk. But there are risks to that, right? There's inflation is one that we're living with today. If you park all your money in the bank, earning 1 or 2%, and inflation is at 8%, and that person is long for this earth, right? Then we're beating down their ability there to buy things, right? We're reducing the value. And my dad used to have a great example of inflation. He said that my dad was born in 1929. So he said that when he was a kid, everything was a nickel, right? A burger was a nickel, French fries were a nickel, a soda was a nickel. You couldn't eat a quarter's worth of food, right? You'd be sick. And then I'm 59. I remember as a kid, McDonald's had hamburger, French fries, and a Coke. It was 99 cents, right? I don't know what it is today, $8, $9, $10. Point is, if my dad had stuck that quarter under his mattress, very safe and secure, and then thought many years later he was going to be able to eat as much as he wanted with it, he'd have been in trouble, right? So it's not prudent, it's not meeting a fiduciary standard in some cases to leave all the money in the bank. If we need some growth to that money to keep up with inflation, to keep up with costs, then you have to keep that in mind as well. Now, planning for the caregiver. And Linda and I know Linda promotes this and it's so important. And I've threatened to get a little box in my office and write soap on it, right? So I could stand on my soapbox. But whenever I get somebody in my office that's a caregiver, I all but jump up and down on the table to tell them they have to take care of themselves. That means physically, it means monetarily. If you are a caregiver, and there's some interesting stats. In fact, let me see. I think I can pull over. I don't know if we can. I'm going to reshare this so you can see it. This is just an article. It's actually on my website, but and it just talks about that family caregivers deserve recognition, of course. But there's a lot of surprising statistics. And you know, I understand I'm preaching to the choir in a certain respect here, if all of you are caregivers, but it's important to note, right, that this idea they call it custodial care. It's non-medical care. Sometimes it is medical care, performing activities of daily living. And a lot of times, again, they're family caregivers. And this states that around 2/3, 66% of family caregivers are women. Spouses, sisters, daughters-in-law. Custodial care can also be provided by a professional caregiver, but professional care can be expensive. And so that's not always feasible or possible. When a caregiver is often an act of love, right? Family members who want to provide custodial care, but they suffer from temporary or permanent pause of career and family life, right? It's a big financial burden. You can't go to work every day. You can't have that income coming in. Huge financial burden. Emotion, stress, fatigue, depression, resentment and anger among siblings, right? I'm caring for mom and you're not. And you know, that can cause problems. Financial loss, again, you're not able to work. Maybe there's some extra expenses with food and care, and there's worry and guilt. And my point, and again, if I could jump up and down and not be off the camera when I did so, you have to take care of yourself first, right? It's the old analogy of being on the airplane and the oxygen mask drops down and the stewardess says you have to put your mask on first before you can take care of that person next to you, right? Because if you can't breathe, then you can't help that person. If you're financially struggling and going down the tubes financially, you're not going to be able to continue to help that person that you're caring for. This talks about the impact of caregiving on women. Family caregivers spend around 24.4 hours per week providing care. As family caregivers, women have faced financial impactful decisions, including 33% work less hours, passed up on job promotions. They have to take a leave of absence, switch from full-time to part-time. Some quit their jobs and some take an early retirement. You know, Social Security could be something in play for you as a caregiver, but you know that the longer you wait, right, you can take it as early as 62 or as late as 70. And the longer that you wait, the more substantial the amount per month becomes. But sometimes people are forced to take it early, and over your lifetime, that can make a dramatic difference, right? So we want to try and do all we can to care for your financial well-being as well as the person that you're caring for. And there are ways to do that. Why Medicare may not cover custodial care is a whole nother conversation. But I just wanted to share some of those stats with you. And I think it's important that we recognize that the caregiver needs to be cared for as well.
Amen.
Can you see my screen, Linda?
Yes.
Okay, let me just restart this. Oops, I jumped ahead. Okay. Okay, so your finances. One of the things that especially if you work for a large company and you're the caregiver, they call it PTO, right? Paid time off. And it's amazing some of the benefits, especially larger corporations have for people in this situation now having to provide care. It's usually temporary, but it can be a tremendous help, right? There are paid days that you can take. There's assistance that some of these corporations will give. And you know how you find out? You ask. And it's amazing. Again, it's one of those things they're not going to run to you and tell you necessarily, but you want to ask and make sure that that's covered. Covering your income temporarily, the shortfall is something that we run into. One of the things that I see happens is you love that person that you're caring for, and there are bill collectors coming after them, or there are medical bills that come due, and you want to help them, so you sign off on it, right? And I've seen this too many times. You put your name on their bill. The hospital says, will you agree to cover this expense? Or that bill collector's calling and they say, hey, you know, we're going to do this if this person doesn't pay their bill. Please try to avoid doing that if at all possible. There are ways, there are things in our country, there is protections for that person if they're ill, both from medical bills. There are forms of financial protection and even bankruptcies and things that will ultimately help in terms of medical bills. But once you sign off on them and you put your name on it, you say, I pledge, I agree, I'm going to take care of this. If this person can't, now you put yourself on the hook. And again, I've seen this happen a few times, and it's really, really unfortunate, because there would have ultimately those costs would have been dismissed or done away with at some point in time. And you wouldn't have had to cover those. So just be very careful about that. Again, not ruining your long-term finances for theirs. People have retirement accounts. They take money out of their 401k. They stop working. They do a lot of these things when there are other benefits or other options. So just that same analogy with the oxygen mask, just be careful not to forget to take care of yourself by taking care of the others. And again, it's okay to think multi-generational. So we all feel funny about the idea of I'm trying to protect assets that might have been mom and dad's or spouses for myself. And certainly I would hope that you want to spend their assets for their benefit, for their care. But there are ways and there are things to help mitigate that you can hopefully save some of those assets or spend that person you're caring for's assets in a way that helps protect those assets for that next generation. And I find that sometimes people feel guilty about that. Well, they say, no, I just want mom and dad to have, or whoever that person is you're caring for, to have what they need. And that's lovely. And I think you should do that. But there are still ways to do that. And there are assets that are more protected, or like the home that I mentioned, and things like that, that we want to try and protect those things and qualify for those benefits that may be available. Because if we do so, they'll still get the care that they need. They'll still get what they need, but there could be assets that transfer to the next generation. And my point is, it's okay to think about that. You don't need to feel guilty about that. You're not going to do something, I understand, that would mitigate or reduce their care, right? We want to make sure that they get that care, but it's okay to think multi-generational. So with that, that's all of my slides. I don't know, Linda, am I able to take questions?
Yeah, and then we have a question here.
Okay.
And it says, how do I have this conversation with my parents? They don't even want to talk about it.
That's a great question. So there are people, family members that are very private. We have, and I'm going to answer the question, I promise, but just a quick story.
Yeah, no,
there's something now that we, as financial advisors and investment advisors, if you could imagine, we get a call from Mrs. Smith, and Mrs. Smith is telling me about the pink elephants that she's seeing in the room, and she needs money to feed them, right? I mean, whatever that craziness is, and we're concerned, right? And we know that she's not in her right mind. It used to be that we had an issue where we couldn't call the son or daughter and say, hey, we've got an account for Mrs. Smith, your mother, and she doesn't seem right. Because what happened on a couple of occasions is then Mrs. Smith came out of it and she said, you know what? I didn't want that son or daughter to know about that account. And now they do. And you shouldn't have called them. So we have a thing now on our new account forms. It's called a trusted contact. And that trusted contact, and they actually very much encourage us to get that on a new account. And the reason is it gives us the authority to call that person. Now that person is not power of attorney. They can't buy anything, they can't sell anything, they can't take money out, they can't make any investment decisions, but it gives us as the advisor the authority to call that person named and say, hey, is Mrs. Smith okay? Have you talked to her lately?
Yeah.
We've got an account and she's asking for money and we're not sure it's a good idea. So that's important. If you can get named as that trusted person, you can say, Mom and Dad, I know you have these accounts. Or you might have some accounts. I understand you don't want us to know about them, but this is one way to do so. The other thing is, it's always a tough conversation because of their privacy. It depends on the relationship, obviously, but my suggestion is to pose the question, to bring it up to them that, you want to help. You're here to help. You want to make sure that their bills get paid. You want to make sure that the collectors don't come to their door. You want to just make sure that they're comfortable and able. And I guess the best way that I've found to make it so that they know it's not about you, it's about them, is to say, look, if it's not me, who would you like? But you need to have somebody, right?
Yeah.
It's okay if it's not me. Even if I'm your son, your daughter, that's okay. If it's a good trusted friend, but we need to have somebody. If you don't want me to know about it, that's fine. But we need to have somebody. Who could we get involved that you could disclose this information to, that you would be comfortable with? That because somebody needs to know. Because if you can't handle, like I used the example of the life insurance contract. If nobody knows, nobody can help. And so you've got somebody needs to know.
Well, and sometimes we think it's harder than it is to have the conversation because some of it's our own issues. So one of my caregivers, it was last year, and it was right before Thanksgiving, actually. And I always think that's a good time when you get around the holidays and families together. Mm-hmm. And she said, so she started asking her parents these questions, and they said, oh, we're so happy you asked us because we didn't think you could handle it, and we didn't want to upset you, and we didn't want to. And she said, and we laid out everything that day. And after that, we got documents done and the whole deal. So sometimes we might be more apprehensive about the conversation than not. So it's always worth a try to start.
right? What's the saying? If you never ask, the answer's always no, right?
Right.
So you have to ask, you have to bring it up. And I guess the other cautionary tale is that you, assuming you I'm speaking to as the caregiver, sometimes it's hard not to be offended, but it may be a different family member that they chose for that role. And we talk to our clients all the time about trying to pick the right person for the job. And sometimes the thought is, well, they automatically go to the eldest, right? If they're talking about their children, but the eldest may not be the ideal person to make that decision. So, for example,
none of your children might be the right person either.
Yeah, correct.
Now, that's another thing. You don't have to keep it in your family.
Correct. It can be a friend. It can be, you can hire a professional to do those types of things. There are professional fiduciaries. There are professional guardians. There are all these folks that can come into play. But we talk about that healthcare document, right? That person who's going to be that healthcare person to take care of your things. And to me, that person should be what I call the table pounder, right? They say, oh, well, I asked this person because they're so sweet and kind and gentle, which is nice. But we all know if you're in the hospital, and I truly believe that the nurses and the doctors are all well-meaning, but I also believe they're very understaffed. And sometimes you need that person to say, doggone it, this is what mom needs, and this is what's going to happen. And so that to me is the right person for that job. And it may not be the eldest, it may not be a family member at all. So picking the right person for those things, I think, is important.
And I think people have to remember, you can change it. You can change it. So, maybe at this age, you don't think your child is mature enough, let's say, or whatever, to make some medical decisions. So it could be your sister, but then as your child gets older and then they're more responsible, you might want to change that. So I think people think they do it once and they're stuck, and they're not.
I see another question, Linda, asking about can't find the paperwork on mom's life insurance policy and she has passed. We know that she had one. And that's a challenge. I wish I had, I believe there should be a clearinghouse of this information. At least I'm not aware of one. But if you know the company, or if you can find an old check ledger where they wrote the premium payment, anything that would give you an idea where to start, if you call that company and you can give them the social and the information and so on and so forth, they will disclose it to you. They're not going to hide, but you have to know where to call. And without that information, again, so important that you share. It's great to have those policies, the life insurance, the long-term care, but boy, talk about something that, you're starting that conversation with mom and dad and you don't know how to start it. If nobody knows those things are there, then you can't help with them, and they're just money wasted, really, if they're not.
But that's a good idea to go to a check register, because especially a lot of those people that age wrote checks and continue to write checks. And
a lot of them kept files. I laugh about it, but when my dad passed, he had files. I remember he had bought a desk like 30 years ago, and he had the receipt for the desk in a file. He was one of those people that if there was a warranty on it, boy, he had bought a Rubbermaid garbage can that had a lifetime warranty, so he had that receipt, right, just in case. So you want to make sure that you can get that.
Well, I'd like to make another suggestion too, if possible. Get to know your parents or whoever you're caring for. Get to know their banker if possible, their bank. Because the bank can help you with many things. Sometimes the bank sees your parents more often than you do. So they can see changes, and they may even know about a life insurance policy or something that they can look up on their records. But I think it's good because, recently one of my caregivers, her dad went to the bank and he was getting scammed, and he was ready to take out like a whole lot of money. And they called the daughter and just said, we just want to check with you. And he would have got scammed.
Yeah.
So it's a good thing to know your people's banking.
And I see another question about an expiration date, and the honest answer is I'm not sure. I don't know if there's an end date to how long you can collect the life insurance. I'm not aware of one, but that doesn't mean that there isn't one. But boy, I would sure file it if I knew about it. There is in Florida it's fltreasurehunt.org. Let me see if I can pull that up here. and share it with you. So that's a lost,
Like a lost and found?
lost and found of monies, right? Refunds, things that were owed to somebody, dividend checks, things like that, where the monies were sent out and it was never received, or checks were never cashed, or stocks were never claimed.
Right.
There is a repository for that, but it's in the state where they were domiciled when they had it. So if they lived in
Okay.
Florida, it was this fltreasurehunt.com. You can literally Google and say lost items in the state of New York, in the state
Okay.
of New Jersey, and there is a state repository where you can file and claim those items. I had a client that found a $40,000 account. I had another client that had been given some Apple stock many, many years ago and couldn't find the certificate, and it had just been lost, and it's called escheated to the state. That doesn't mean that the state gets to keep it. It means they're the holder of it up and until and unless somebody claims it. So
Wow.
good
They're
place to
just
look.
babysitting for you.
Yeah.
Well, that's good stuff. I hope we answered all your questions. If anybody has any other questions after the conference, you can always email me and I will contact Mark, and I'm sure he will answer to the best of his ability.
I would be happy to.
So thank you so much for being with me, my friend. I look forward to talking to you soon.
Thank you. Thanks,
Have a
everybody.
delicious day.